Welcome to the Real Estate Explainer podcast, where we talk about anything and everything real estate. I'm your host, Brian Kixula. Today, we've got Alex talking about DSCR loans. Let's jump right into the episode. Just want to say thanks for jumping on the podcast.
Thanks for having me. I'm a father of 3 boys. I live in Los Angeles. I'm an out-of-state real estate investor. I host a monthly real estate investor meetup here in LA, and I'm the most reviewed DSCR focused loan officer on Bigger Pockets.
My background, I told you a little bit before we got on the podcast, is I got into mortgages back in 2002, so a long time ago now. And my background was really doing residential, FHA, VA, conventional financing for whether it was first-time home buyers or investors coming back to buy their 5th, 6th, 7th property. I've done a handful of hard money loans, but over the last 20 years or so, the mortgage markets have really changed. And getting a loan as a real estate investor has just become such a giant pain in the butt for the most part. Not with all lenders when it comes to conventional financing, but most of the time.
So you have experience with a lot of that Fannie and Freddie backed products, which you guys have a ton of red tape, a ton of compliance stuff you got to follow in terms of the borrower's personal ability to repay the loan. Whereas a DSCR loan is based on that acronym, the debt service coverage ratio of the property. So these are business purpose mortgages where we're not looking at tax returns. We're not looking at your personal debt to income ratios. We simply look for a strong credit score and that the monthly rent is going to be sufficient to cover the PITI.
So now you're not going to ask the client to provide a copy of their W-2s, tax returns?
Nope. I've done dozens of loans for people where I never even ask them where they work, or it never even comes up.
So it's not part of the supporting documents that you're asking for on the front end. It just doesn't come in an equation.
No, and it's not always that the borrower doesn't have great income, right? Oftentimes it's just that it's a nightmare to document it for Fannie and Freddie's boxes that you need to check. Or they make a ton of money and they do an excellent job of utilizing stuff like cost segregation and different tax strategies to actually make their debt to income ratio not pencil very well on paper.
That's a cool thing. And I think that's what the real takeaway here is, that you're looking at the property. The property has to make sense for the lender to want to lend on it before you're going to move forward. Is that accurate?
That's right. Where LTV-wise, you'll find a typical max loan to values for a purchase using a DSCR loan would be 80%, so 20% down, assuming that provides positive cash flow. And on cash out, you'll find some 80 out there, but primarily industry standard 75%.
Are you looking at an ARV, so after repaired value, or are those loans within your wheelhouse?
Absolutely. So in many cases, I'd say 3/4 of my pipeline is actually cash out refis. And that's partially because I market myself as the BRRRR guy on social media, right? So I do BRRRR investing myself. It's always been what's most fascinating to me. And if you don't know what BRRRR is, listeners, it's basically the fix and hold strategy, right? You're going to buy a distressed property under market value, fix it up, force the value up, and then attempt to get a cash out refi using that new appraised value, and hopefully leave very little money of your own in the deal.
So you're doing cash out refinances. That's what you said 3/4 of your business is. So are folks funding their own loans or funding their own projects to get started and then coming back to you and using the DSCR loan to do a cash out refinance?
Yeah, I see a wide variety of things happen there. A lot of times my clients purchase and renovate a property all cash and then come to me to get taken out. Sometimes they use private money for that purchase and acquisition. Sometimes I originate the hard money loan, right? Because we also do some of that. 90% of the purchase, 100% of the rehab, short-term hard money loans. But you mentioned, do DSCR loans work off of ARV? And only in so much as seasoning, right? Forget whether you qualify for Fannie and Freddie based on your debt to income ratio. What may be the sole determining factor of why you might go DSCR is simply seasoning on a BRRRR. So as of spring of last year, Fannie and Freddie changed their guidelines to where if you used purchase financing, that meaning there's a first position lien on the property, you need to wait 12 months before you can do a cash out refi using the new appraised value. Now with DSCR loans, we have options with no seasoning, meaning we'll do it as soon as you've made the repairs, but more often than not, I'm utilizing a program that only requires 90 days of seasoning. So if you can follow me there, we get a guy who gets into a property, fixes it up real fast, and then sometime around day 45 or 60, they're listing the property for rent. At that point, we're ordering an appraisal and structuring a new loan up to 75% of that new value.
Okay, interesting. So what I was thinking is that you would only be using the DSCR loans on the initial acquisition. So this is a twist in my brain because I would think that you would use a loan strictly for the acquisition. And I didn't even think about using a hard money loan to acquire the property, maybe 9% a year to get into the property. So you buy it, you rehab it, but you want to get out of that loan as fast as possible and put in some permanent financing. Your loan all of a sudden works because you're not looking for that 12-month seasoning. You can get in right away, and now you bought the property for, let's say, $200,000. You put $50,000 into it. Now the house is worth $350,000 or $400,000. You're taking that new $350,000 or $400,000 so the investor can pull their initial cash outlay out and then pay back that loan. So that's a really cool strategy to use this loan program.
Absolutely. It works very well with people who want to use that private money. And then those hard money lenders love us, right? Because most of them write 12-month notes, but you'll find a lot of boutique shops around the country who really only want to write 6-month notes. And these are great maybe for fast-paced fix and flippers, but it makes life slightly more complicated for fix and hold investors unless they're partnered with someone like us who knows how to get it done faster.
Yeah, because a hard money guy makes his money on the churn. So he wants to keep originating those loans, take that same pool of money. What do you think the upfront points are? Typically 3 to 6?
Oh, that varies so much depending on the source and everything else. But with us, I'd say the average loan that we do on that side of things, where we're doing 90% of the purchase, 100% of the rehab, average rate is somewhere in the 10s or 11s today with 2 to 2.5 points.
That's not too bad if it's 2 to 2.5 points.
And consider that we're on the aggressive side of things, more institutional capital, whereas you might find somebody within your network who wants to charge more, but maybe in exchange it's a little bit more of a handshake agreement where it's just let me know when to send the wire, whereas we're doing a little bit more due diligence.
No, and I think that is where a lender really adds value as well, or broker, because they're underwriting the deal for you, or they're helping you underwrite the deal. Because sometimes people are too eager to jump into that real estate transaction because they have the cash that they can use to buy the property and they see this big outcome that they can have. But the reality is maybe they don't know the market as well as they should. And a lot of times the lenders are going to hit the pause button and say, hey, this is not the best deal for you to invest in. And that turns me over to one of the next questions that I see. We just touched on what the underwriting looks like. So they're underwriting the property itself, and they're looking for the debt service coverage. So then what does a good ratio look like? So let's say that I may be able to rent this property for $2,000 per month. What does a deal need to do so that the lender's willing to sign that check for you?
Believe it or not, really probably just want to see a PITI at $1,999.99 or below. So most banks that are doing commercial mortgages, which at the end of the day are basically DSCR based loans, they typically want to see like a pretty conservative debt service coverage ratio where they're not only dividing by PITI, they're also including things like a vacancy factor, property management, utilities, a market vacancy factor, things like that. We're really only looking at rent divided by PITI, and we're only looking to clear a 1.0 for max leverage. So it's incredibly aggressive. Surely you're rewarded a little bit in rate for superior DSCRs, right? Like we have a certain rate sheet where you get a couple bips improvement. If you're above a 1.4, you get dinged on 1.0 and 1.15 because you're basically airtight, right? You're basically break even. And the truth is, if we're qualifying a loan at 1.0, it's worse than break even, right? Because we're not actually counting some real life expenses like property management, vacancy.
Yeah, repair and maintenance items that are definitely going to pop up. You move in, or if they move in, the hot water tank blows or something, the HVAC goes. If you haven't set aside the additional funds, it's going to mess with your overall ratios. But to restate that, just because we're using a lot of acronyms, if you will, is it's 1-to-1, guys. $2,000 a month in rent, $2,000 a month in coverage. So that gets you into the property if you have that 20% to put down. This is not a 100% financing or basing it on some future values. You have to have the cash in the property.
If you're looking to utilize a DSCR loan for purchase financing, it's important to note that the property needs to be considered rent ready or leased. So if it's a leased property, it's totally turnkey. Then we're doing a debt service coverage ratio based on the actual in-place rent divided by PITI, assuming that rent seems to be in line with the market. If it's vacant, we can still do that, but we're going to use the appraiser's opinion of the market rent to calculate the DSCR on what we call a 1007. It's a form type within the appraisal that we add to a traditional appraisal, which doesn't just include sales comps, it includes some similar properties nearby and what they rent for to determine a market rent for this unit.
All right, that's interesting. So having a property that is already leased is going to be superior because it eliminates that unknown when it comes to what the market rate really is. Because I imagine that most appraisers are going to be a little bit more conservative.
When in doubt, probably.
Yep. Now, when you go about qualifying for a DSCR loan, are you looking at the real estate investor's history? Hey, I own 5 other rental properties. Or could someone that's looking to step into becoming a brand new landlord take advantage of this type of loan? I'd like to thank today's sponsor, CostSeg RX, a cost segregation company. If you're interested in a cost segregation study, log on to realestateexplainer.com and click the cost segregation link at the top of the page.
Great question. In general, we like to see that the borrower has ownership in some real estate. Most of these DSCR lenders will have within their guidelines that it's not a first-time home buyer. However, it can be a first-time investor if they own their primary. But truth is, we're often getting exceptions because it's becoming more and more common to have creditworthy borrowers who say live in LA or San Francisco or New York, and before they're ready to buy a primary for $1 to $2 million in that neighborhood, they'd prefer to start accumulating some rentals in cash flowing markets like the Midwest. And so we have programs to accommodate that too for first-time investors. There are some rate sheets that do slightly reward borrowers in rate for extensive experience, but what's more often the case is that experience comes in handy when we're looking to get an exception. Let's say a file looks pretty clean, but there's just a tiny bit of hair on it that's not meeting a guideline. We need to request an exception, and those exceptions always need to be accompanied by some type of a compensating factor. That might be excellent FICO, excellent liquid reserves. It could be experience. We recently did a loan at 75% LTV for a foreign national. He's a citizen of Australia, but he's lived here for 15 years, owns a $2 million house and 30 rentals. And typically, lenders want to cap foreign nationals at 60 or 65% LTV, much lower leverage.
Or not lend on them at all. They'll just say it's a hard no. So that's completely real. And I think what you just said is cool to bring it back to. And this is something that I think a lot of people need to look at when they're looking at jumping into real estate, is that you don't have to jump in as a homeowner. A lot of people do feel disenfranchised because they live in these high cost areas. They live down in San Diego or somewhere in New Jersey, or they're out in Hawaii where they're just not able to buy a property that they're comfortable living in for as much as it's going to cost if they're buying it, where you could literally go pick up a property in Kansas City for $160,000, or you could go to Lake Charles, Louisiana and get a property for $120,000. And this type of loan would be a great opportunity to step into that market without having to go through the underwriting guidelines that you're capped out with conventional loans.
I'm a perfect example of that. I rent my primary here in Los Angeles to live 100 yards from my in-laws with my 3 kids, and I own 20 rental units in Missouri and Texas. Just makes more sense for me at this moment.
Absolutely. Yeah. But one of the big things that I always like to look at too is what's the downside of these loans? And I already know what I think it is, but I could be totally wrong. And I was looking on your website, and what's super cool, and we'll talk about it in a second, this isn't a black box. You can go to the website and actually plug in the criteria. It'll tell you if the property work or not the specific address, but if the property meets the guidelines to qualify for the loan. So I'd encourage you to talk about that in just a second. But the downside I see to these loans is most loans have prepayment penalties. You're going to have a prepay on the loan. So you're not going to get into this and then flip it to a conventional loan in 2 months or even 2 years. What does it mean when you're looking at a 3-2-1 or a 5-4-3-2-1 prepay? What does that really mean? I'd like to thank today's sponsor, CostSeg RX, a cost segregation company. If you're interested in a cost segregation study, log on to realestateexplainer.com and click the cost segregation link at the top of the page.
Yeah, that's a good thing to bring up. Since these loans are not backed by the federal government sponsored entities like Fannie Mae and Freddie Mac, they rely on secondary market investors on Wall Street or life insurance companies, hedge funds, these types of entities. So for them, it's all about balance of risk and reward and minimum yields. It's true. To be competitive on rate, most DSCR loans will have some type of prepayment penalty. Most common, or at least with us, would be a sliding or a step down type of prepayment penalty. Right now, the two most common structures would be either a 5-year or a 3-year. So that means either a 5-4-3-2-1 or a 3-2-1. And how that works is like in the case of the 3-2-1, if you paid that loan off, whether it was a sale or refi in the first 12 months, you would incur a 3% fee based on the loan balance. You have a loan for $100,000, you pay it off early in the first year, that payoff demand that goes out will be for $103,000. If you did that in year 2, it's only 2%. If you did it in year 3, it's only 1%. And then after that 36 month, after the third year, there's no penalty at all. So you could look at that as a potential downside, but what's really funny is I would have said that historically the downside would be rate. You'd say, oh, these are riskier loan products that rely on private investors, essentially. They're going to get you in rate. And historically, I'd say DSCR loans have been 100 to 200 bips higher than conventional. But today, play around with that calculator and then reference like Rocket Mortgage for the same scenario, we're actually pricing inside of Fannie and Freddie today in many scenarios.
Yeah, I saw that. Blew my mind. I was taken back by that because I thought in addition to being stuck with that prepayment penalty, you'd get hit with a much higher interest rate. But the reality is it wasn't a bad interest rate at all on an investment property. And the cool thing too is it was a 30-year fix. Back in 2003 and 4, they would write a 3-year prepayment penalty on a 2-year arm. So your fixed period comes up and all of a sudden the rate's jacked up, but you can't get out of it because you have a prepayment penalty. That wasn't the case. This is a 30-year fixed, a very competitive rate, but you do have that prepay.
There are a lot of investors out there. We meet them all the time. And I love meeting ones that have this great relationship with their local bank and they have a big portfolio of dozens of rentals and they think they're getting the best terms in the world. But it turns out they have a decent rate on 5 or 10-year term with 20-year amortization. And they still have to supply financials. They still have to do all these hoops. And I love being the one to introduce them to this concept of, like, no, man, if that thing cash flows, we're going to put it on 10 years of more AM at a similar or even lower rate, fixed for 30 years with half of the paperwork.
That's what you're talking about because it monkeys up your cash flow if you've got a 20-year term. So having that 30-year term to help out. So you're absolutely right.
Yeah. And so what Brian was talking about, guys, on our website, if you go to investorpropertyloan.com/DSCR, we have this brand new pricing engine available to you. And this is obviously a great way for us to originate loans without manually doing so much math because we've built it into this underlying spreadsheet. But I think the awesome value for borrowers too is really just to have it as a tab open on your phone that you use to pre-underwrite your deals. Well, I found myself when I was shopping for rentals in the beginning, I often would cheat and use like these internal broker channel calculators that we use to qualify loans. And I just use that as like a litmus test to see if this is a good deal or not. And so you can do that with our calculator where you'll see you can just punch in some basic variables on the deal. Is it a purchase or a refi? What's the value? What's the monthly rent? What's your FICO score? Taxes, insurance. And as soon as you filled those in, you instantly get rates, fees, monthly payments, max LTV, the ability to toggle.
You're also not asking for your name, email address, and phone number. So you're not getting bombarded with sales calls while you're playing along with the calculator, playing with the calculator. And I thought that was really nice too, because the last thing you want to do is have a broker call you or a mortgage guy call you if you're not really ready to move forward. You want to qualify yourself, qualify the deal, and then advance to that next stage. And then that gets into the next question that I had is once you go through and you identify that this property works, let's say it's a purchase in this scenario, it's not a cash out refinance. Would you then move forward and click the submit button and get more information to get pre-approved or pre-qualified prior to making the purchase?
Yeah, so the calculator is not meant to necessarily remove my white glove service from the scenario. It's just to simplify one big time consuming element of it, which is the pricing out of scenarios. If it's purchase and we haven't worked together before, the best way to get started would be to punch in the details of your scenario to the best of your knowledge there, hit get started, then it'll ask for your name, number, and email. Then I'll be prompted. I'll get a little postcard of your scenario so that I can review it. And then I would reach out to you to collect some documents that we would need for a pre-approval. And on a DSCR loan, that's very basic. It's driver's license, 2 months worth of the most recent bank statements. And if you're using an LLC, your LLC documents. And we didn't really touch on that, but that's probably one of the top 3 benefits or reasons why someone might use a DSCR loan over conventional, despite all the other reasons we've already laid out, is the ability to vest title in an entity. So most of the loans we do, the borrower is an LLC, and investors love this for tax reasons, anonymity, liability, and different things.
I could buy a property with my brother or my brothers or my friends or other partners that I brought into the deal, and we're all tied up in an LLC. Is that accurate or no?
That happens all the time. We see family members split or just business partner split, husband, wife split, and everything in between.
You're asking for everybody's information that's on the LLC.
To various extents. Right? So what we require is one personal guarantor who owns at least 20% of that LLC to serve as basically the guarantor of the loan, even though this loan will not report to their credit as a trade line. It's not a consumer loan, but we do need someone that we can pull credit on for qualification. So sometimes one person decides to take that responsibility in a group. Other times they split it. Sometimes there's a strategic reason. Maybe one person's FICO's tanked and the other's is great. And we just use the one that's great.
All right. And then, so once they've done that, they're ready to move forward. Do you issue like a traditional pre-qualification letter?
Yeah. So in the case of a purchase, like we said, you'd go through that, just get an idea of pricing. I'd get in touch with you and request a few documents from you. And then same day issue a pre-approval letter. On DSCR loans, I really like to make them property specific. I think it makes them look stronger. And it's just a little bit more realistic. I can say on my letter, based on the proposed debt service coverage ratio of the property located at 123 Main Street, the borrower was pre-approved on the following terms.
Are you then ordering an appraisal on the property, same as a traditional loan?
Yeah, we do order an appraisal. The difference between ours and a traditional loan is that rent schedule. So a traditional only requires a 1004 form, which is sales comps. You add to that the 1007, which is the rental comparables. Our appraisal might cost like $100 to $200 more. I'd say right now they're anywhere in the $600 to $800 range.
That's pretty standard, though. If you're asking the appraiser to do rent comps, they're going to charge you for it. So it absolutely makes sense. Now, what about the condition of the property? Do you lend on properties that are maybe not ready to go? Maybe it needs something. Are you willing to move forward on those, or is it they need to be ready to go day one?
Since we're not documenting your personal ability to pay that mortgage with your personal income, we're qualifying it based on the rent. We really want it to be rent ready. There is a certain threshold, though, which we can get away with. Like right now, specifically in our best price program on a purchase, if there are deferred maintenance items called out by the appraiser that we think makes it not rent ready, like in your case, maybe ripped up carpets, chipped paint, broken siding. If we can get an invoice from a contractor that states that the repairs noted are less than $2,500 in cost, we will actually approve that, put $2,500 in escrow, and release it to you once you've done those repairs post-closing.
That's great. So I work with a bunch of masterminds across the country that typically the individual that founded the mastermind have property that they're selling on an ongoing basis, meaning that's their primary business is to sell real estate. They'll go in, they'll work with local builders or local rehab guys that are bringing properties to market that are rent ready. They've already run all the studies on them, so they know that they're good rental properties, turnkey, and priced right for the area. I feel like this loan would be the perfect fit for these masterminds. That way they could take their base, who are typically people who want to become real estate investors, and they're just connecting the dots. Here's the property. Here's the loan. Here's the property manager. Now you're comfortable to buy that property in Columbus, Georgia. Now you're comfortable to buy the property in Oklahoma. Let's move forward because we've given you all the tools.
Totally. We love working and partnering with turnkey companies because what they are doing is trying to sell a cash flowing rental property to somebody who wants just investment. And those are built to cash flow. So they obviously are easy for us to underwrite. And typically they're pretty freshly renovated.
Perfect. And I was just looking through my notes to see if I'd missed anything as a prospective client that's jumping into the scenario. What questions didn't I ask during this episode when it comes to this specific loan type?
You asked a lot of great ones. I would just say that I started out like you did in residential mortgages and really wasn't loving it. I got on Bigger Pockets as a means of learning about real estate investing because I knew it was something I always wanted to do, even though I didn't have the cash to do it yet. And I found everyone asking the same questions. And it was stuff like, hey, I want to invest title in my LLC, but my loan officer says I can't. I want to cash out my BRRRR. Loan officer says I can't. A loan officer says I can't have more than 10 finance properties. My DTI doesn't work. Around 2017, got acquainted with these business purpose loans because it made my life so much easier. These are easier deals to originate. I can make this a yes or no math question, less emotional. And then it also is perfectly suited to make investors' lives a lot easier. And so my natural transition to this point has been, how do I make that transaction as fluid as possible? And this calculator, I think, is like really going to take it to the next level because right now it's a functioning widget where you can pre-underwrite your deal to see if it makes any sense. You can get an idea of where our rates and terms stand today, even if you're not ready to pull the trigger yet. You're just trying to get an idea. And ultimately, week over week, we're just going to be adding features to this portal, if you will, make it the most user-friendly experience possible.
No, I'm going to say I jumped on there, like I said earlier today, and I was playing around with it. And I think the cool thing for me to use it, I could say, okay, if I'm buying this property for $250,000 and then I make up the rental amount, how much am I going to be able to rent it for? $1,350, $1,500, $1,600. It's going to tell me how much cash I need to bring into the deal, $100,000. So I know that property might not work based on the rent that it's generating if I don't have $100,000. So then you really have to start identifying, okay, what properties work? And then, like we were talking about, it's not just in your backyard. So you're not in Los Angeles. You're looking at Middletown, Ohio, Sulphur, Louisiana. You're looking at these other markets that are out there that have the rental price points to make it work with that specific out-of-pocket overlay. So definitely a cool calculator.
Don't get me wrong, we love doing loans in California when we can, but the truth is these are super attractive in the Midwest and South where you have properties where the average monthly rent covers a mortgage at 75 or 80% loan to value, which just doesn't exist in some of these more expensive coastal markets.
Absolutely. These are for non-owner occupied properties on residential real estate. We're not talking about commercial deals. So it's not for a warehouse, correct?
That's correct. It's primarily the bucket is 1 to 4 unit residential properties. So single families, duplexes, triplexes, fourplexes. We even have a bucket for 5 through 8 unit small balance multifamily.
And then the loan range, what's your minimum? And then where are you seeing your maximums?
I'm glad you asked that because a lot of lenders cap their minimum loan amount at $150,000 or $100,000. We actually go as low as $75,000, which is great for a lot of these markets in Ohio where you have properties worth 110, 105, 120, and you need a hair below $100,000 loan to make the deal work. $75,000 minimum, up to $2 million is easy on a DSCR loan for 1 to 4 units. Beyond that, if you're looking for $2 to $5 million, it's available as well, typically at reduced leverage, lower LTVs.
Perfect. And then what's the best way for the listeners to get in touch with you?
Yeah, best ways would be either Bigger Pockets. You can find me, Alex Bekeza, Bekeza, or on Instagram, Bekeza the BRRRR Lender. And my email is alex@investorpropertyloan.com.
Perfect. Thanks for jumping on the podcast today.
Yeah, thank you, Brian.
If you'd like to get connected with today's guest, log on to realestateexplainer.com and click the Get Connected button on the homepage. If you'd like to get connected with today's guest, log on to realestateexplainer.com and click the Get Connected button on the homepage.